slides throughout the presentation to ensure you can get a complete perspective on these changes and updates. So I'll let Mary introduce herself.
Good morning, everyone. I'm Mary Whitlatch, and I am the tax supervisor for our Brentwood office. I'm looking forward to speaking with you today, and I hope we can give you some helpful information that will benefit you and your business. I would like to start off today's webinar by telling you a little bit about our firm. We are an accounting firm that has been serving the community for over 70 years. We have 2 locations, one in Clarksville and one in Brentwood. We have about 40 employees and 40 partners, and we offer a variety of services that allow us to serve an array of clients. Some of these services include preparing federal, state, and local tax returns for individuals, businesses, trusts, and estates. We perform bookkeeping services and assist with preparing information returns, such as 1099s and W-2s. We also have an audit team that performs audits, reviews, and compilations. Caitlin will now take over to go over the topics we'll be discussing today.
Today's presentation is going to cover 4 key areas designed to help you prepare for the upcoming and future tax seasons, mainly focusing on that 2025 and 2026. We'll begin with an overview of significant tax changes taking effect in 2025 and 2026 under our wonderful One Big Beautiful Bill Act, which was finalized July 4th, and any other related provisions highlighting what's most relevant for small businesses. We'll also go over federal and local due dates for more commonly filed forms and registrations both on the federal and state level to help you stay on top of important deadlines. From there, we'll take a look at strategies for maximizing deductions and minimizing penalties so you can make the most of available opportunities, as well as best practices for maintaining compliance, record keeping, and filing to ensure accuracy and avoid costly errors. Mary is going to start us off with our tax changes for the 2025 tax year.
Mary, before we turn it over to you, just a few quick reminders. If you have any questions along the way, we have the question and answer area where you can put any question you have in there. No question is a bad question because if you're thinking about it, others are also thinking about it. So feel free to ask questions and we'll answer them throughout the presentation.
Thank you, Lauren. Yes, that is correct. Please ask any questions you have. That's why we are here today, to help you and to answer those questions that you've been wanting to ask. Okay. So as Caitlin mentioned, I'm going to start off by talking about some of the 2025 changes due to the One Big Beautiful Bill Act, or the OBBBA, as you will see it mentioned throughout our presentation. This act is important as it made multiple changes to the law, including permanent extension of laws, changes in laws, removal of laws, and implementation of new laws. We could talk for hours about the implications of this act, as it is 870 pages long. However, for time's sake, we'll be discussing topics we think it's important for every business owner to know. The first topic we're going to discuss is the Qualified Business Income Deduction. This deduction was part of the 2017 Tax Cuts and Jobs Act, or the TCJA, and was set to expire at the end of 2025. Luckily, the OBBBA made this deduction permanent. For those who do not know, this is a 20% deduction for businesses, other than C corporations, that is taken on the business owner's personal return. The deduction is taken before taxable income and is 20% of your net qualified business income after certain deductions and is subject to thresholds and limitations. In 2026, there will be a slight change to this QBI deduction, as a new $400 minimum deduction has been established. As long as a taxpayer has $1,000 of qualified business income from an active trade or business, they will receive at least a $400 deduction. Some of the changes to the current laws that this act made was to depreciation. Caitlin will be discussing this in more detail later on, but it made adjustments to bonus depreciation, Section 179, and research and development costs. Another change the act made was to the state and local itemized tax deduction. The TCJA in 2018 made the maximum deduction for state and local taxes on Schedule A $10,000. The OBBBA now increases this maximum to $40,000, though it is subject to adjusted gross income thresholds that could lower this back to $10,000. For business owners that have income in multiple states, this will help you if you itemize instead of taking the standard deduction. The 3 new deductions that we'll be talking to you about today is the tip deduction, overtime deduction, and the auto loan interest deduction. All 3 of these deductions will be above the line deductions that reduce your taxable income. The OBBBA created a new deduction for tips. You would notice that the slide title is "No Tax on Tips" in quotation marks. We did this because there are many people saying that the OBBBA made these tips not taxable. However, this is not the case. This new temporary provision created a deduction of up to $25,000 for tips received from 2025 through 2028 if the taxpayer meets certain requirements, such as their adjusted gross income being under $150,000 or $300,000 if married. In addition, if they are married, they must file jointly. They cannot file separately in order to claim this deduction. This $25,000 deduction does not increase if you are married, and it is not $25,000 per spouse. It is a maximum deduction of $25,000 per tax return. This will be available for eligible employees and self-employed individuals that receive qualified cash tips in IRS recognized occupations. The IRS website that we have listed on our slide lists out the occupations that qualify. These occupations are ones that the IRS has deemed to ordinarily and customarily receive tips for 2025. Unfortunately, if your business is not on this list, then you and your employees will not be eligible for this deduction as of now. However, the IRS has said that they may update this list yearly, so keep a lookout for that if you are not currently on this list. Tips that qualify for this deduction are ones that are paid in cash or cash equivalents, such as cards or checks. In addition, tip sharing amounts. However, only voluntary tips qualify. If the customer cannot modify this payment or forego paying it at all, then that tip does not qualify. An example of a payment that you could not modify or forgo would be when a restaurant charges an automatic 15% service charge if a party has more than 8 people. Those tips would not qualify for this deduction. A question you may already have is, how is this tip income going to be taxed on a paycheck? It is still subject to FICA taxes, Social Security, and Medicare, and it will stay that way. And however, as of now, it is still subject to federal income taxes on each paycheck. The IRS has came out and said that they have not had enough time to update the withholding rules for 2025. So right now, it's going to keep being taken out and withheld on, but luckily, when the taxpayers go to file their personal return and they're eligible for this deduction, then it will either increase their refund or offset other balance due. The IRS has said, though, that they are looking to update the withholding rules for 2026. Also for 2025, the IRS has said that they have not updated the W-2 or 1099 forms, which this law has said the tips have to be recorded on. And they also say that on these tax forms, it will be required that the occupation of the employee will have to be listed on there. But because the IRS has not had time to update these forms, they're going to provide transition relief for taxpayers and for employers, so that for 2025, people are still able to take advantage of this deduction. Because it's up in the air and how exactly this is going to be handled, I really recommend meeting with your tax advisor early. They'll be able to tell you what they will need in order to get you this deduction and help you figure out what you'll need to provide to your employees so they can claim this deduction. So just like the last slide, the no tax on overtime is also in quotation marks, as this new provision is only just a deduction. If an individual or a self-employed taxpayer receives qualified overtime compensation, they may receive up to a $12,500 deduction or $25,000 deduction if they're married. And the IRS has said that the qualified overtime compensation pay has to be pay required under Section 7 of the Fair Labor Standards Act of 1938. There are requirements a taxpayer must meet in order to qualify for this deduction. Their adjusted gross income has to be under $150,000 or $300,000 if married. They must also file jointly. Married filing separately, taxpayers do not qualify. Just like the tip income, this income will still be subject to FICA taxes, and as of now will be subject to the federal income taxes on each paycheck. And as I said, hopefully by 2026, the withholding rules will be updated so eligible employees can see an increase in each paycheck instead of receiving their eligible deduction when they file their tax return. In order to take this deduction, it also must be reported on a tax form such as W-2 or a 1099. And for 2025, the IRS said for the overtime deduction as well, they're going to provide that transition relief because they have not updated the forms. So for employees and employers, you can still claim this deduction in 2025. And again, please meet with your tax advisors, just like the tip deduction, so you can find out from them what's going to be needed in order to claim this, since the tax forms have not been updated from the IRS. This deduction does have one important stipulation, and that is that only the half portion of time and a half is deductible. For example, if an employee's normal rate is $20 an hour, then they'll only be able to deduct the additional $10 for every hour of qualified overtime pay that they receive. The stipulation is also why it's going to be important to do the tax planning and meet with your advisors so you can make sure to calculate the correct overtime deduction that you're going to be eligible for. And next up, Caitlin will be discussing the new auto loan interest deduction that started January 1st, 2025.
Thank you, Mary. Continuing with our no tax deductions and quotations, a new and notable deduction under the One Big Beautiful Bill Act allows individuals, both itemizing and non-itemizing, to deduct interest paid on loans used to purchase new personal use vehicles. However, lease payments don't qualify for this deduction. The deduction is capped at $10,000 per year, and it begins to phase out for taxpayers with modified adjusted gross income above $100,000 for single filers and $200,000 for joint filers. To qualify, the loan must be originated after December 31st, 2024, and the vehicle must be new, used for personal purposes, and secured by a lien on the car. The VIN must be reported on the tax return for any year the deduction is claimed for eligible vehicles. But what is an eligible vehicle? So eligible vehicles include most cars, SUVs, trucks, vans, and motorcycles. That was new, with a gross vehicle weight under 14,000 pounds, and they must have final assembly in the United States, which can be verified using the VIN or through the NHTSA VIN decoder. I have included the link. However, the IRS has included it on their site as well as some guidance on taking this. On the lending side, dealerships and financial institutions will need to stay compliant with the new IRS reporting requirements for the vehicle loan interest, which could influence administrative processes and customer communications. We have to be very open about this, make sure that they do qualify and they can take advantage. Lenders are now required to report qualified interest received from borrowers to the IRS, similar to how mortgage interest is reported. If a business receives $600 or more in annual interest from an individual on a qualifying vehicle loan, it must file an information return and provide a statement to the borrower showing all of that information. The IRS has provided transitional penalty relief and guidance for lenders adjusting to these new reporting requirements for 2025. And I have included a link to that as well. Just a fair warning, it is pretty long, but it does go into really great detail on what to do. This new deduction is especially important for business owners who provide financing options through their business. You need to know all of the information surrounding that. Now we're going to get into some more notable changes with depreciation and expensing, as Mary mentioned earlier. One of our most impactful changes coming in 2025 for businesses is the restoration of 100% bonus depreciation for qualified production property. This means that businesses will once again be able to immediately deduct the full cost of qualifying assets, such as machinery, equipment, or certain building improvements acquired after January 19th, 2025, so this year. Property acquired and placed into service before this date is subject to the prior phase down of 40%, and I'll go over what the previous rules for that was. For example, a manufacturer that purchases new production equipment and places it into service for $50,000 could deduct the entire amount in that first year rather than depreciating it over time and taking a smaller deduction every year. The act also introduces a new temporary 100% first year depreciation deduction rule for qualifying domestic non-residential real property used in manufacturing or production activities, a category typically ineligible for bonus depreciation. There's a little advantage there. Construction must begin after January 19th, 2025 and before January 1st, 2029. And the property must be placed into service after July 4th, 2025, which is when that bill passed, and by January 1st, 2031. So in previous years, if you may not know, bonus depreciation gradually phased down from 100% under the TCJA, which is the Tax Cuts and Jobs Act. It allowed businesses to fully deduct the costs of qualifying assets in the year they were placed in service, but the rate began decreasing after 2022. It dropped to 80% in 2023, 60% in 2024, and it was scheduled to continue declining to 40% in 2025 and 20% in 2026. So that's where the 40% comes in for assets placed in the service before that January 19th, 2025. And then after that, it was just eliminated altogether. This phase down reduced the immediate tax benefit for businesses, making the upcoming restoration of the full 100% bonus depreciation a really significant advantage moving forward. This can really help businesses. In addition, the Section 179 deduction limit that can be used with the bonus depreciation will increase to $2.5 million, with the phase out beginning at $4 million. This expansion benefits small and mid-sized businesses investing in tangible assets like vehicles, computers, and office furniture. The higher thresholds mean more companies can expense their full purchases up front instead of spreading those deductions over several years, taking the smaller depreciation. And finally, the immediate expensing of domestic research and development costs, which is a little bit rare for some businesses, will be reinstated, reversing the recent requirement to amortize R&D expenses over 5 years. So this change will particularly help innovative businesses and startups investing in product development or process improvements by allowing them to deduct those costs as incurred instead of spreading it out over those 5 years, bringing up more cash flow, kind of giving the opportunity for more reinvestment and growth.
Caitlin and Mary, we have a question.
Yes.
For the auto loan interest deduction, is that only for brand new cars, not used?
Correct.
Can you go more in detail about that? Share more information?
You have to purchase a brand new vehicle. So it cannot be a used vehicle that is new to you. It has to have no previous owners. Like it is a brand new vehicle right off the lot.
Thank you.
Sorry, readjust my Zoom. As we look ahead to the 2026 tax year, a range of provisions are also now in the spotlight due to the recent One Big Beautiful Bill Act and the annual adjustments from the Internal Revenue Service, the IRS. For business owners, this means more than just checking boxes. It means rethinking planning strategies around your cash flow, your investments, depreciation, especially the timing of income and deduction. When do I want to receive this income? When do I want to buy this property, equipment, things like that? What is the best way to balance everything out? So this next group of provisions focuses on business interest deductions and updated reporting threshold that will simplify compliance for many businesses. The first, the EBITDA-based limitation on business net interest deductions will be permanently reinstated, reversing the previous shift to the stricter EBIT standard came from the TCJA. This means businesses can once again include depreciation and amortization when calculating their allowable interest expense, which could provide some greater flexibility and a larger deductions for especially for capital intensive industries. Additionally, the reporting thresholds for 1099 forms are changed. So for some businesses, this is really significant for them. For forms 1099 NEC and 1099 miscellaneous, the general threshold will increase from $600 to $2,000. This is going to reduce the number of small payments that require reporting and easing some administrative burdens for smaller businesses. And for Form 1099-K, the bill restores the previous threshold of $20,000 in payments and 200 transactions, which will help many small sellers and gig workers to avoid receiving unnecessary reporting forms for small or infrequent transactions, just because it is so high. Higher reporting thresholds for 1099 forms mean fewer forms to track and file, which can save time, resources, money. It can be a huge benefit for a lot of businesses. And finally, on this slide to wrap it up, there are new rules surrounding charitable contribution deductions. So for C corporations, a 1% floor based on taxable income will now apply before any charitable deduction can be claimed. So they have to meet that. And then for individuals who itemize, the floor is 0.5%. However, there is also a new opportunity for non-itemizers. Itemizers and non-itemizers can now claim up to $1,000, $2,000 for joint filers in charitable cash contributions. So you won't have to meet those requirements to itemize to take all those contributions, as long as it's under that $1,000 and $2,000. And now Mary's going to go over some credits and changes to expenses that you're probably going to see for the 2026 tax year, as well as a lot of credits that we will no longer be able to take advantage of in 2025 and 2026.
Thank you, Caitlin. So starting in 2026, the OBBBA has increased and reinstated some of the business and individual tax credits and deductions. There's a couple I'm going to go over to you today. The first is the Child Care Assistance Program. And this is when an employer is able to exclude from an employee's income an amount that is used for child care expenses. This used to be $5,000 a year, and then starting in 2026, this is going to be $7,500 a year. So you're going to see your employees that are already taking advantage of this be able to take advantage of this more to pay for their child care costs. Also in connection with employer child care benefits is the employer provided child care credit. This is a credit that is available to eligible employers who provide child care services to their employees. The credit used to be a maximum of $150,000 a year, but is now a maximum of $500,000 a year, or $600,000 for those who meet the small business classification requirements. If you provide these services, you may be eligible for a 40% credit of your qualified child care facility expenses, such as constructing a new facility or expanding one, or even certain yearly expenses, such as employee training and certain compensation. If you're currently providing this service or thinking about providing this service, please talk to your tax advisor so you make sure that you're taking advantage of this tax credit. Another change for 2026 that I'd like to discuss is the deductibility of employer-provided meals to employees. All employer-provided meals to employees were set to become non-deductible at the end of 2025. Thankfully, the OBBBA reinstated some of this deduction if you fall under the following two categories. Meals will be 50% deductible when provided at a facility where the meals are sold by the business. For example, a restaurant that provides food to their employees on their breaks. meals will be 100% deductible when required by federal law to be provided. If your employer provided meals to employees does not fall under the two categories, unfortunately, they will no longer be deductible starting 1/1/26. The OBBBA does not change, though, the deductibility of other types of business meals, such as with clients when traveling or company-wide events. Those are still 50% or 100% available, depending on the type of meal that it is. I recommend talking with your tax advisor on how best to keep track of these new non-deductible meals expenses, as you will need to probably put them in a separate category so they don't get mixed in with the deductible meals. So as you can see from our slide, there are some credits expiring in 2025 and 2026. The OBBBA repealed a lot of the clean energy credits. Some are like for example, September 30th, the new clean vehicle credit and the used clean vehicle credit went away. So before you make any clean energy purchases for tax purposes, just make sure that you are checking them, that it has not already expired, these credits. And today, that is everything that we'll be discussing on the One Big Beautiful Bill Act. Following all these changes and updates, Caitlin will be discussing due dates for you to be aware of as a business owner to help you stay on track. And I will be coming back to discuss some tax strategies to help you maximize deductions and reduce penalties.
Thanks, Mary. So when it comes to federal filings and local due dates, or I guess due dates in general, I apologize. Staying organized is key to avoiding penalties and ensuring smooth year-end compliance. You don't want to always just save everything for the end. You want to be aware of it throughout the year. It's easier to plan for that way. Federal filing and payment deadlines are a critical component of compliance and tax planning for businesses. And I know, especially with our firm, this is a very, very large focus for a section of our firm. For calendar year taxpayers, your individual returns, which is your 1040, and C corporation returns, your Form 1120, are due April 15th, while S corporation, your Form 1120S, and partnership returns, your Form 1065, are due March 5th, before any extensions may come into effect if they refer to this. Quarterly estimated tax payments follow a standard schedule, April 15th, June 15th, September 15th, and January 15th, as you can see on the slide. Estimated tax payments can be paid on the state level in addition to the federal level. Depending upon your income, estimates can be calculated as the lesser of 100% of prior tax owed or 90% of current year tax owed. And for higher income earners, the lesser of 110% of the prior year or 100% of the current year. Even though individuals and businesses may not be required to pay in estimated taxes, it may be beneficial to, based on future tax planning and changes in income and withholdings for following years, just based on what you anticipate might happen in the future. I know we can't always predict the future, but sometimes we can plan for it. Those who are required to pay in estimated taxes, though, due to their tax liabilities, they have to pay in quarterly to avoid penalties and interest. And Mary will also touch on this towards the end of our presentation. Employers must also remain attentive to payroll reporting requirements, including timely deposits for Forms 940 and 941. Can vary based on the business size and payroll frequency. There's definitely something to discuss with a tax preparer and do some tax planning with, as well as the accurate preparation and distribution of W-2 and 1099 forms. Adherence to these deadlines is essential, not only for regulatory compliance, but also for effective year-round tax planning. So we really want to stay on top of this. And narrowing down to the state and local side, there's several different common filings for businesses. For sales and use taxes, filing deadlines vary by frequency. Monthly filers, they have to submit by the 20th of each month, while quarterly filings are due on the 20th of the month following the quarter's end. Typically, they're filed through TINTAP or directly with the Kentucky Department of Revenue. Tennessee franchise and excise taxes are due by April 15th, while annual reports filed with the Secretary of State are due June 30th for Kentucky and the first day of the fourth month following year end for Tennessee. Tennessee tangible personal property tax returns are due March 1st. Local obligations include sales and use taxes, which are consistent with state filing schedules. So typically they will provide those deadlines for you. Excuse me. Tennessee business owners may be subject to city and county business tax, which are due by April 15th. Typically, you'll have to reach out to your local authority if you do require it. Kentucky businesses may be subject to net profit returns where applicable, and businesses should note that these filings are typically deductible expenses. So make sure you keep track of those and file them timely and avoid any penalties from that. And both the Tennessee and the Kentucky Secretary of State and Department of Revenue websites provide guidance on filings with additional requirements or exclusion applying depending upon your business type and activity. I know Mary and I often use our Tennessee sites, being a Tennessee business here, and they are incredibly helpful. We love, calling them and get answers. They've always helped us a great amount, and they do presentations themselves as well for businesses that can be really beneficial. Mary is now going to follow, touching up on some topics regarding some proactive tax planning.
Thank you, Caitlin. So to wrap up today's webinar, I'll be talking to you about some tax planning tips to help you maximize deductions, minimize tax penalties, and put yourself in the best position to be successful. Tax planning is something we offer our clients year-round. Depending on your business and your needs, we will perform tax planning yearly or as needed. Tax planning is most crucial when there are significant changes, such as starting a new business, dramatic fluctuations in cash flow, or impactful tax law changes, such as the OBBBA. During your first year of business, it's important to meet with your tax advisor for planning to understand how your income will be taxed, as well as to discuss opportunities to reduce this taxable income through deductions that business owners may or may not be aware of. Some examples of common expenses that I always tell my new clients and current clients is that if you work out of your home and have an office that you use exclusively for business, you can take a deduction for business use of home. Another deduction is the mileage deduction. If you have non-commuting miles for work, you can take a deduction per mile. For 2025, that deduction is 70 cents, and this is updated annually. If you pay for health insurance for you and your employees, this could be deductible depending on certain factors as well. It's also important to do tax planning in years where you have business changes or tax law changes, because timing can be crucial in maximizing your deductions. For example, if you know your business will have a major income increase for the next tax year, then you'll probably need to defer some expenses to that year to keep you in a lower bracket and offset that income. It can work the opposite way as well. If your income will end up being higher than you thought in the current year, if you meet with your tax advisor before December 31st, they can give you tips on how to lower that, such as buying a piece of equipment that you needed now instead of waiting a couple months into the next tax year. Timing can be crucial in tax savings because of the tax bracket system. So other than C corporations, we are on this bracket system where the more money you make, the higher tax brackets that you're in. And it's not that you make X amount, you're only in one bracket. It is a hierarchy. So that's why planning can be crucial, because if we know you're going to have more income in one year, then we can try to keep you out of the higher brackets, or at least try to minimize how much you're in the higher brackets. Another tax planning tool is determining what type of entity would be the most advantageous for your specific situation. Entities have different tax benefits and consequences. For example, if you're a C corporation or an S corporation, you're allowed to be on payroll and pay yourself a salary and issue yourself a W-2, which can be huge for self-employment tax reasons. However, if you're a Tennessee business, This then can make you subject to excise tax. We plan with a lot of our corporations in December to try to help them minimize that excise tax. Another example is if you're a sole proprietor. That means you won't be subject to Tennessee franchise tax if you're a Tennessee business. But then at the same time, you won't have liability protections that come with being, something like a single member LLC or an S corporation. So talking to your tax advisor and also an attorney based on your needs will figure out which way is best for you tax-wise and also liability-wise. And then lastly, I want to talk to you about not just maximizing your tax savings and maximizing your deductions, but also minimizing your tax penalties. As Caitlin talked about earlier, the IRS and states require taxpayers to make quarterly estimated tax payments if they meet certain criteria. You can choose not to pay these, or sometimes you'll miss the due dates. However, you will pay underpayment penalties if you do not pay these correctly. And that's why your tax advisors are here, to help you calculate your estimates, to make sure you know what need to pay, and help remind you that you need to pay on these. Something our firm does is we'll send out email blasts before the next due date, a week or two before, to say, hey, don't forget your estimated tax payment due date is coming up. Another topic I like to discuss with all of my clients is record keeping. Record keeping is key when it comes to setting up your business to be successful tax-wise. Keeping track of your income and your expenses accurately ensures all income and expenses are accounted for and allow you to maximize all of your deductions. It also results in a smoother audit process. When you're audited, they're going to want your records. So if you already have them together, it makes it a lot less stressful for you. This is also why I recommend to my clients they should have their own business account separate from their personal account. When you have your own business account, that other than transferring funds to a personal account for your personal reasons, every line item in there is an income or an expense for your business. It makes it a lot less stressful than having to figure out what's personal versus what's business. And you don't have to be a LLC or a corporation to do this. You can be a sole proprietor and just have a separate account in your personal name that's just for business transactions. But please be aware, if you're not a sole proprietorship and you're an LLC or a corporation or an LP, you are required to have a business account according to the IRS, okay? And another thing when it comes to record keeping is some people think you need fancy software in order to keep track of your income and expenses. That's not necessarily the case. It will depend on your company, but a lot of companies now just use QuickBooks Online. Depending on the service you need, they have different tiers. So the lower tiers are not too expensive. It can be used by you, and you can share your QuickBooks with your accountant so they can go in and access it well and have access to your records. They have ways to import bank transactions as well, which will save you a lot of time. Another option I see a lot of my smaller clients use is just an Excel file. They'll have a tab for each month with all their income and expenses, and then they just forward that off to me when it's time to do their return. Your tax advisor might even have a template for you to use. So ask them if you currently do not have something you're using to keep track of your income and expenses. Really, the key is just to make sure you're staying organized. It's going to save you time, stress, and money, because then you are picking up everything that you need to for tax time. And then the last thing to kind of wrap us up is I just want to discuss maintaining communication with your tax advisor. We've been talking a lot today about the new tax law changes, deductions, penalties. Meeting with your tax advisor before December 31st is going to be crucial to take advantage of things during the current year. Your tax advisor is also somebody who is, studying these current law changes, so you don't have to. So go to them, ask them their questions. They know your specific situations, and they'll be able to help you and tell you what is best for you and your business. I also recommend to some of my clients, depending on their situation, to have a good financial advisor or attorney, as we can't give legal advice and other financial advising advice, only tax stuff, okay? Alrighty, everybody. Well, that is all that we have today. I just want to say thank you so much to the Better Business Bureau and Lorna for putting this on. Caitlin and I are so glad that we got to talk to you today. We hope that we gave you some helpful information. And hope that if you have any questions, we're here to answer any final questions for you before we turn it back over.
Any final burning questions you have? We have the experts with us today, so any questions? We'll give them a few more seconds before we move on. While we're waiting to see if we have any other questions, Mary, what is one common thing you see from businesses that they should be doing that they have not been doing in the tax realm? I know you talk about meeting with your tax preparer before the end of the year, but what else? What are some common things you see individuals not doing or businesses
Yes.
not
So
doing?
I touched on this a little bit, but I noticed the biggest thing would be the record keeping. Keeping your business transactions in order separately from your personal before the end of the year. I have a lot of clients, that it comes April 15th, they're like, oh, wait, I need to calculate all my expenses. And it can be really stressful trying to go back a whole year and figure out, okay, what did I get paid for income and what were my expenses? So I think that is the thing I touch on to all of my business clients. Make sure you have a record keeping system in place that works for you, that will allow you to maximize when it comes to your tax return.
Thank you. We have a comment and a question all in one. Steve said thank you both for the presentation, and he also wanted to know if you are both located at the Brentwood office and if you are accepting new clients.
Yes, we are in our Brentwood office, and yes, we are accepting new clients. So please, our contact information is there. I am in our Brentwood office. I handle the new client intake. So please give me a call or shoot me an email. I'll be happy.
Well, thank you everyone for being here with us today. Once again, as a reminder, at the end of this presentation, we will send out the recording to you. We will also send you a feedback request, a survey for you to fill out. Let us know all the things we're doing well, all the things we can improve on, because that only helps us get better to provide you more and more value. Thank you again to our presenters. Thank you to my fearless leader, President and CEO Robin Householder, for always supporting what we do for our community. Everyone have a great day.
Thank you.